All right, it's my great pleasure to have Michael, my good friend here, who's the creator of the Vixen volatility system. And we've been talking about the amazing metrics that this posts, and he's going to give us a little bit of insight into volatility edges in general and his system. And he's going to talk about how you can potentially trade this system through his signal service or his auto trading service. Before we start, I'll let him talk, but I just want to say that Michael was the first person that I started to build trading systems with. Everything that I learned at the same time as him. So we sort of started from the same place, except he's a programmer and I'm not. And so everything that you think that I know, he knows this and more. He's a very good quant trader and a very good trader, and also a very good technical analyst, even though he doesn't use that much anymore. So I'll hand it over to Michael and teach us something.
Thanks, Scott. We're definitely brothers in crime here, but I don't know about the more. You've really grown as a trader, but thanks for the kind intro. So yeah, I have known Scott for 8 years, I think, right? We've been communicating. Yeah, I started Evil Speculator in 2008, and then I think you came on a year after or so. So it's been quite a journey, and I think we both learned a lot. And I've seen Scott grow as a trader quite extensively, right? I mean, from simple candle-based system into running advanced statistics. And although Scott is not a programmer, he has got like almost an instinctual understanding of how to slice and dice the numbers and look at trending patterns and understand the flow of the tape. Of course, Scott also has been you've been attending a lot of seminars by really top people, so you've learned from the best. Meanwhile, on my end, I've really dug into the quant aspects a lot because I came from a trading background, right? I'm originally a software engineer, and I still write code, but mostly for myself, not for other people, right? Don't work for the man anymore. And I loved writing. I really love writing software. I had times when I'm writing some system, and I go to bed and there's a bug, and then I wake up at 4 a.m. Swear I didn't even think about it, and all of a sudden I know what's going on. So my mind is always churning, right? That's how I'm wired, right? So I've embraced my inner nerd. I get an echo. I don't know what you just did. I think you just turned something on. That's why
I just turned myself off mute. I muted myself and then I unmuted.
Okay, never mind. It doesn't matter. But so I loved the coding, but I really didn't enjoy so much of working in a hierarchical structure. The whole corporate thing, which has gotten a lot worse over the last few years, and I started Evil Speculator and really took off, right? And it was really interesting. And I also had the ability and the privilege to see a lot of people make a lot of bad mistakes, right? So you learn a lot by really interacting very closely with the community, right? And offering your own services and trying to help people and trying to help people avoid the mistakes you've made, because we both, I think, have made a lot of mistakes and we paid for them, right? We learned the hard way. So when I then got deeper and deeper into quant trading, while you were, I think you built your systems and methodically, but also traded them manually, right? So I think you're somewhere in the middle. I always was very much focused on automated traded, full automatic black box trading. Why? Because I think just the thought of just having it run and do its thing is always very tempting. But the problem is that you really exchange one set of problems for another, right? Now you have to watch the tape, and you cannot interact with it. I mean, you're not supposed to. You can't just stop the trade if it looks bad to you, because that's exactly how you screw up a good edge, right? And so in a way, we have gone in the same direction, but I've experienced more like the really hardcore automated side of it. Anyway, so yeah,
from my point of view, trading should be about leveraging your strengths. So yes. my personal strength is in system design, but
absolutely,
when I tried to run the automated systems that you and I developed together, I always felt like I was shitty at my job. You as an order, I was like, I would wake up every day and check these automated systems and make sure they're running. And it was like, I was doing a job that I was never going to be any good at. So I sort of went back to trading manual.
What is your, do you know what your Myers-Briggs is, your personality type?
Yeah, they did it at a Van Tharp seminar, and it was really weird. I can't remember the one, but it was like there was a room full of 50 people, and like 45 of us were the same thing.
Yeah, I'm ENTJ, the commander, and it's kind of interesting because it really nails completely how my personality type is, right? And kind of take charge, but I always sometimes run off without a care and just get her done, right? But also it has weaknesses, and then you really start buying your own bullshit. Anyway, to kind of protect myself from myself in a way, and also make things a little bit more bearable, because we all start up looking at the screen for 8 hours a day, 7.5 if you're just trading the NYC session, and just absolutely ruining your life, right, and barely sleeping. And then we kind of hopefully see the light and actually develop a system that we just follow, methodically, like you also teaching, which I've been teaching on my end, where is it there? Evil Speculator, and then eventually.
If you're watching this is a really cool blog, by the way. I can absolutely recommend Evil Speculator as a community, as a blog. The people there are real traders. It's a really good place.
Yeah, don't come to Evil Speculator. We don't want you there. It's a very exclusive club, and there's an application process. It's really quite extensive. So, which includes clicking on the browser, popping it on the screen, and that's pretty much it. Actually, we're pretty non-discretionary. We take everyone with a pulse and a trading account. Anyway, so. Where were we? Right. Automated systems. And so one thing I definitely learned the hard way over the years is that predict, what you do, you always try to predict price patterns. It's like this inclination. At the same time, we know that we can't predict price very well. And so I follow, when I trade discretionary, which I still do, I usually look at inflection points, right? Similar to the stuff you teach. Obviously, we share a lot. My discretionary trading style is very much like Scott's, right? I have a very limited set of indicators, if any, and I really look at price breakouts, things like that. That's just the way I like to trade. It's my personal style, and it's not for everyone. Some people like swing trading. I like trend trading a lot, and times actually, I think, getting better for trend trading, just as a side note. But when it comes to automated trading, right, it's really a completely different process, and you just let this thing run, and you have to really account for all kinds of things. Let's say it's a Fed day, right? A lot of people just switch their systems off. Well, I had to write a plugin that does that because I saw certain systems get wiped out during those days. Stop run, and so. You actually wind up recreating a lot when you do this kind of stuff. You end up building this whole infrastructure, year after year, that replicates a lot of the decision process that you make discretionary, which is like all natural to you. Okay, I don't trade today. Well, the freaking code doesn't know that, right? The code doesn't look at the event page for the day. So anyway, price patterns is what you really go after, and it's kind of natural, right? Because we all have this tendency, we want to predict price action. And of course, we all fall on our noses doing that. Now, the one thing I learned when I was steeping more into the quant world, I taught myself Python. I was always actually more object-oriented programmer. I know Python has objects, but just it's not as strongly typed. And but when I started teaching myself Python, especially, I think it started 2 years ago, I realized very quickly there's a lot of things that come with it which are really cool, which is like a lot of science libraries and a lot of great libraries for instance there's pandas which allows you to slice and dice huge data sets just like you would do with Excel, right? You don't have to really write complicated code, and it allowed me to do a lot of really cool things and projections. And when I looked at all these alpha factors that I kept testing, the one thing became clear that directional, price direction is very hard to predict. And so I started increasingly over the last few years, even before I got into that, I was looking a lot at volatility, because I think volatility is really a very underestimated aspect of trading, and that most people don't understand it properly. You know, I think we covered some of this last time. Real estate versus implied.
Let's flesh that out for some of the people who are on my list. So, from my point of view, volatility is far more predictable than price.
It is.
Price is not particularly predictable at all, whereas volatility is somewhat predictable, right?
Price is semi-predictable in certain situations, which we refer to as inflection points, like you know. And if you either Scott, if you don't know what we're talking about, I think Scott recurrently writes about it. I write about it all the time, so feel free to listen to either of us. But volatility is a lot more predictable. Hence, there's guards, right? Of course, the problem is that unsigned versus signed integer, you know, because although volatility, realized volatility, or you know, implied volatility is predictable. You don't know which direction it'll go, right? You don't know if it's going to go up or down. So if you know there's going to be an increase in volatility, you don't know if in realized volatility, right? You don't know if actually you know, it's going to go drop hard or if it's going up. And so that is the one issue with predicting volatility. And a lot of really good people have been trying to solve that problem, right? And especially in the quant world. Ernie Chan is one of them, right? And he's written extensively about it, and he's doing really good work. So I dug myself, along with a quant buddy, actually, we dug ourselves deep into volatility patterns and volatility analysis, but also into the products that are being traded, like, you know, particularly VXX, the UVXY, SVXY, TVIX to a certain extent. There's Vixen, there's a bunch of them, and so your system runs on the ETFs that are tracking the volatility index. Exactly.
And you can get long only ones that'll work for 401k accounts as well, for retirement accounts as well.
Yeah. Okay. If you can only trade long, right, you probably should go with the SVXY, because you at least with the system that we're trading, you want to short volatility. That's what the system is based on, because based on the edges we've tested over the last 10 years, on 1 minute chart, it's a hell of a lot of data. It's really the short side. You don't want to really. There's also, you know, the contango problem, right? In that, you know, these people always think of, let's say, the you know, the VXX, right? For example, very popular ATP, that it follows the VIX. It doesn't really follow the VIX. It actually follows the SPVXSP, which is an index that tracks two futures, the two front a month, front month and the next one, right? Futures contracts, and it balances accordingly, right? Based on volatility movements, implied volatility movements. So,
can you trade this on the futures account, on the futures as well?
You could trade it on the futures. We haven't done it. We trade directly, but yeah, it's possible you could trade it on the futers. But it explicitly,
the futures are very liquid.
They are very liquid, but also, quite honestly, UVXY, SVXY, and VXX are quite liquid as well. Just some traders have a problem trading it at particular brokers. So if you can't trade it, you might want to find yourself a different broker, right?
Gotcha.
Yeah, that's. Or you can also trade your options, right?
Well, that's my next question. So, are you buying in the money, out of the money? You're buying slightly in the money?
In the money, 7% plus. So you want to be deep in the money. You want to go front month, right?
So can you flesh that out a little bit for someone who's maybe a beginner?
Yeah, totally. Okay, I don't know if you guys have traded options, but you probably heard of theta burn, and you know, basically over time your option becomes worthless, and so it's called theta burn. You know, it's on a constant basis, and it basically is also exponential, meaning that if you see if you see theta, a curve, right, and it kind of really drops hard towards the end. It's kind of like this, right? Drops a little bit. Let's say it's 3 months out, right? Yeah. Go ahead.
In the real world, about the last week or so before expiry it just falls apart, right?
Well, no, that's a misunderstanding. I mean, there's still. The behavior changes, right? And in the last week, especially in the last few days, we're approaching zero. And so, especially if you trade in a money options, right, they start behaving like mini futures contracts. which is kind of cool, right? And also the reason why you want to go in the money is to avoid this whole mess with, with the Greeks, right? You don't want to have to deal with large variations in Vega and Theta in particular, volatility-based or time-based. And you really want to focus on price, and so you want to be in the money, and you want to be deeper in the money. I consider about 7% plus is optimal, right? And you can also go deeper, yeah. And so then you're basically trading them like little futures contracts, right? Which is also a lot of times more affordable.
Oh, so I get it. So as the time value of the options contract goes towards trends towards zero, it becomes effectively just like futures contract. With intrinsic value only, with massive leverage. Right?
Exactly. Yes. Yeah. Exactly. Gotcha. Intrinsic value only. Keyword. So, and keep in mind the systems, and you guys probably don't know that the systems we trade, you don't hold overnight, so you don't need any overnight margin or any of that. We basically take a trade. We always close up before the end of the session, so there's no risk in holding overnight. You go to sleep, and all of a sudden, market blew up, and you're broke. That doesn't happen. I don't want this to happen to me.
So the signals happen in the morning, or they can happen at any time of day. How does it work?
Exactly at 1 p.m. every day. No, they happen when they happen. They might happen right after the bell. No, actually, they might happen about half an hour in. That's when we actually start, because we need to accumulate some data, and then it might happen anytime. We don't know. And there might also, we trade for, right? VXX, UVXY. They go the same. They go basically with the VIX, SVXY, which is inverse, and which one and TVIX, which also is directional. They all of them have slightly different leverage, but you basically are trading. The system always trades short volatility, right? It looks at spikes outside, outside a certain threshold, and then shorts volatility.
So let's flesh this out. So. Yeah. For the guys who have my system building course, I'm always recommending that you base your systems around a fundamental property of markets that is uncontroversial, that we know is true. Now, the fundamental basis of this is that volatility is mean reverting. So that if you look at a chart of the VIX, or if you look at any volatility, you get massive spikes have an extremely, extremely strong tendency to mean revert, and so the fundamental basis of this system, it actually makes sense. It's not some mathematical model that could be curve fitting. It's something that we actually know is true. Am I right?
Well, you could have a mathematical model that's curve fitting.
Yeah,
we've done that too. But yes, I mean, the thing is, the majority of the time, volatility has a tendency to, implied volatility has a tendency to mean revert. Well, what does it mean revert to? It's like a random walk, right, that volatility goes through. Also, volatility is also slightly heteroscedastic in that it starts behaving a little bit different.
No big words, man. Come on, you gotta explain the big word.
I'm sorry. Heteroscedasticity. It means that let's say you have mean reversion, right? You have a chart, and you have like this. You have shown this chart before, right? You've like, how do I do this in front of the camera? Let me kind of size me up.
We're talking about fat. Are you talking about platykurtosis?
No. We're not talking about standard deviation here. The bell curve. No, we're talking about just like let's say it's like you have a regression, right, with the error terms. So like a scatter chart. It's like a normal scatter chart, right? And you see the scatter right here, right? So normally, if you have a nice fitting line, right, you have to. I'm trying to do this. I have to do this opposite. Let's just kind of. So you have to fit line, right, and there's all these data points around it, right? So when you're trying to find a good fit, so what happens normally, if you have a nice fit, okay, cool. But a lot of times you have things where it's like this, right? It goes, right? Here's the bubble of data, the fit is here, and then it starts fanning out towards the end, or maybe it fans out in the beginning and then starts tightening up. That indicates that, let me switch back here, that indicates that you're dealing with a data set that's non-linear, right? The behavior is such changing as the signal strength or some other factor starts either reducing or expanding. Does it make sense? So that's what I'm talking about. Anyway, that's the VIX and VXV and all these volatility index. VXV is the VIX 3M now. They behave slightly different when volatility expands. And why is that? It sounds very esoteric to you guys, but think about it. How does market behavior change when things go really apeshit, right? When things really go crazy, everyone starts running around with a hair on fire. What happened to me? Look at me.
High volatility is a proxy for strong emotions.
Yeah.
Everything behaves totally different. I was watching that stupid marijuana stock Tilray last week that everyone was talking about.
Oh yeah,
and you can see some stupid Canadian pot stock with no assets that spiked to be $15 billion worth, went up 500% in 2 weeks, that kind of thing.
Did you short it?
I don't short those things. That's not for me. I just watch from the sidelines.
Yeah, and laugh. So where was I? Yeah, heteroscedasticity. What I meant to say is that volatility changes, which is the reason why in certain volatility periods we don't trade the system at all. So if you guys ever sign up or trade the system,
you're going to push this out.
Yeah,
you have a system which is always the fundamental basis is mean reverting on volatility extremes.
Yeah,
and you're trading it on ETFs or options on the ETFs of the VIX products, and there's a number of different ones depending on which one your broker will let you borrow.
Exactly.
You can do a long the inverse, or you can do shorts.
Yeah.
Shorting I know is mathematically slightly better, but going long the inverse is okay if you're only legally allowed to do that because of your retirement accounts.
They asked me why you just go long. Yeah.
And this system that you've built, it's got an expectancy of between
depending what you trade, and we get to that in a bit, 0.33 and 0.48.
Between 0.33 and 0.48, which for fully automated systems is just amazing. It's like really hitting it out of the park. Yeah. And it takes how many trades on average per year?
Per year, about 200.
About 200 a year, so about one per trading day on average.
Yeah.
And so you can trade this by signal service, which you have, right?
That's combined, by the way, 200. You can trade by signal service. It's not really time sensitive, in that if, let's say, the signal hits and you get it on your phone, and you don't have to rush. I mean, you have probably 5, 10 minutes, 30 minutes even, because sometimes you even get a much better fill. I've seen it fill, and then it's like, had it just filled 5 minutes later. But how are you going to know?
That's kind of key, because a lot of signal services, they become very execution specific. Like you're trying to scalp a few ticks, and you missed it. It's already done.
Right. You don't have to sit in front of the screen all day and wait for with your eye on the phone. It's like, you know how to put it in now. It's
okay. So overall, this is an extremely strong edge. It's easy to trade.
Yeah.
They don't need any maths knowledge, do they? They don't need to. Even though it's nice that they understand this, they don't need to be a maths nerd like you, right?
Well, you need to be able to read. You need to be able to read, so you can read the alert and then press the button on your trading console.
So it's really like that. This is quant trading for people like me who aren't smart like you.
Oh, come on, man. I think you're really selling yourself short in probably your audience. Look, it's something I spend a lot of work developing. And look, not everyone has time doing that. Not everyone is a full-time trader, and that they can spend a whole freaking weekend. They have children. They can spend a whole freaking weekend running analysis. I don't profess myself to be much smarter than the majority of people listening. So
it's just you've grinded it out.
Yeah, grinded out. What I might not have in intelligence, I make up with sheer stubbornness. Right? I just grind through it. So I think a lot of people can probably replicate what I did, but it's a hell of a lot of work. It took me 2 years to build this system, along with another quant trader who was, I think.
You worked with a very experienced quant trader from a big firm to develop this. So you were sort of standing on the shoulders of someone who'd already done this for a big firm and was already a volatility trader for a big fund, right?
Yeah, I was actually pretty fortunate meeting this guy. I met him through evil speculator. He was a lot of people actually in the industry following me. I don't know why, but
I get that too. It's weird.
And we started talking, like it happens sometimes, and I got really interested where he's working, because he was always he seemed to like a lot what I posted about volatility, and specifically because it's something he was focusing on. And so that's how we started working together. We said, okay, look at this, and then we start bouncing back and forth, Python notebooks, which is like just a way to share code and then just run it right on your browser. And it was really cool, and so this collaboration struck up, and we just started like when you have a good brainstorming session and things start really flowing together, and before you know it, you're working on a system for 2 years. It's kind of nuts, and that's kind of how this happened. So yeah, it's probably my best work yet. I've developed systems for like 10 years now, as you know, and I think this is really my best work up to this point, because it really has a completely different approach than most systems I've seen. First up, it trades volatility, and also it uses a machine learning model which does not try to predict, but just sets a baseline, right? Remember the baseline I talked about, when you have like a scatter chart, you see the trend, you know what the model usually it's supposed to do when, let's say, alpha factor A, B, C, D are doing this. That's what, for instance, the VXX should be doing. If it doesn't do that, then we have a deviation. And if it then pushes beyond that threshold, a certain threshold, what's really extreme, then the odds support in that moment, again, inflection point, right? Support reversal. And that's what we're doing. It's actually quite easy.
What I find really interesting about this approach is that you're not trading the classic mean reversion is against price, right? But here you're trading mean reversion against the model. So you're developing this complicated machine learning model of the way the market should behave if the shit is normal, right? And then when something goes weird, like the market character changes, you're going, okay, well, something's weird now, and I'm going to trade the change that will eventually happen back to normal.
Yeah, it's when something starts happening outside of in quotes, established parameters, then you might have a trading opportunity. You don't always have it, right? The system actually has it does very well, but it has a 50-50 win-loss rate. Nevertheless has a high edge, because why? Because we exploit when it happens, which happens about half of the time. It's like a coin flip, right? At that moment, the resolution usually is significant, and that's what we're exploiting. And I think that's how you build systems, right? As opposed to trying to find something that always happens, which really never happens, or rarely happens these days, because everything's arbitrage. Sorry, go ahead.
Are you using stops? So systems like this typically don't use stops, right? Like you just buy your thing and you sell it at the end of the day, right?
Yeah, we use stops, absolutely. The stop is based on, Frogbox, right? Kind of long and stuff like that. It's based on a Frogbox system of a range of previous price movement over the last 30 days, and we're looking, okay, we don't want to, okay, 1 second, if it's pushing beyond that, then it's bust, so we stop out.
Okay, so for people who don't know what that is, the Frogbox is a system by Ken Long, which Daniel actually learned from him, and it's part of the system building masterclass. It's a very simple mechanical system. Really easy to trade, but it's based around the standard deviation of the previous moves. So you're saying if there's more than a certain amount of move, then that's more than you're expecting.
Yes, it's really it's basically the range of the previous moves, and if it pushes beyond that, there's various ways how we could have done that. You could use just a price range, and it's all the same, right? It's really there's probably 100 ways, and we don't know. At some point you just pick something and use it.
But the Frogbox is an interesting idea. That's a cool concept.
Yeah, you can also do the Z-score out of that stuff. It's simple. It's the same concept where you then basically divide by standard deviation, and you get like a score, and it's actually quite cool. Once you get into this, and that's why I like so much about Python, right? You have ideas like that, and you should really keep studying a little bit on the Python end, because I think you would have a lot of fun, because you love Excel, right? You're like an Excel fiend. Just for the record, guys, Scott, I'm the programmer, right? I've programmed for 30 years. I cannot do what Scott does in Excel. I'm absolutely suck at Excel. That's why I was programming everything. And he's really good at Excel and slicing and dicing the numbers. I think you would have much more fun with, once you get the concept of pandas, you would love doing, you would love using that, because it's the same. It's just, you don't see the spreadsheet, but you can do all this crap. Well, I'm going to show it. I'm going to show it on the notebook I have. So maybe we should get to that.
Well, let's get to that, because we don't want to string.
Yeah. It's probably two people left by now. So, okay, I have to actually switch my desktops. Okay, here you are. All right, cool.
Okay, guys. So Python lets you execute simple programs sort of in the browser, like without compiling and going back. So you can use these little notebooks as like research tools. Yeah. So you can try something else. That you like do instant back tests, instant all kinds of stuff, instant scatter plots. So this is the absolute perfect if you had to design from scratch a research for system building environment.
Yeah.
Especially this Pandas library and Python combination. This is the shit.
Yeah, there's all kinds of stuff. Pandas is great. You also have things like scikit-learn, which is which allows you to do a lot of data analysis, which is really brilliant. It just, you see, I know this looks really nerdy, guys. Just bear with me. I've got goodies waiting right below. The fold here. So what you're looking at basically is just a bunch of code I wrote just to kind of do data representation. And these are just like little methods I can call. And so, sorry, my voice is giving a bit, I have allergies. So let's get to the results. So what I'm doing here is basically I'm ingesting right here in this line, I'm ingesting some backtests I run, right, based on my alpha factors in my system. And I look at it and I did some, slicing and dicing. And what I do here is basically I just, run some code that just shows me the performance and then plots right here the statistics, right? And we see the testing period, which we always want to know. This is from 2014 through 2018, like a few days ago, the 18th. And we've got 1,698 trades. I mean, that is
that's
all.
A lot of trades.
Yeah, it's a lot of trades. But it's all four symbols, right? I'm sorry, all three. That's. I had some problems with the TVIX and ingesting it here, and so I just did it with these three. So I got it done for you guys. But we've got VXX, UVXY, and SVXY, which is inverse, right? And that is the combined basic, taking every trade that's possible based on the alpha factors that we go by with the system. And so that's the expectancy here, 0.32, right, which I mentioned before. And again, the things you want to look at are the winning trades 49%, right? That's the win-loss range, which I mentioned, which barely actually changes as we scroll down, which is also interesting. The max drawdown, and again, that's for four symbols if you would trade 1 R, like 1% each, right? So I need to really put this into context because nobody would do this, right? You would divide this by 3. Max drawdown was 36R, which is, of course, if you divide this by 3, you're somewhere on 12, which is actually quite good because you would,
12R is fine, 36R is not fine.
No, exactly. But it would be 12R because you would only, trade 1/3% for each symbol if you trade them all. Or you trade one symbol only, let's say the SVXY, and you'd be around 12, 13 as well. Make sense? Am I good?
Correct.
All right. So,
all right, moving on.
Stats. Honestly, I don't know what I think I was just popping things out.
Okay, so is you're rating your trades on a model for like 0, 1, 2, 3, 4, and 5. And so people who want to take less trades but have higher quality trades will take only the 5-star trades or the 4-star trades, and you can take fewer trades, smaller drawdowns, and a higher expectancy, or you can make more overall and put up with some greater drawdowns. Is that roughly the way it works?
Yeah, well, now you just took away everything I was about to present, so we're done. No, yeah, I'm getting to that in a minute. So here I'm just running some stats in terms of correlation. I'm doing a rolling window and see let's
look at that rolling sharp.
Okay, what does that mean? I'm just doing a rolling sharp basically on the statistics, which basically shows me how does a system feels like. Okay, I never seen anyone do this, but this is how the system feels like. You know, maybe you sign up here. I don't know if you can see me right in the beginning of this chart here in the center. Can you guys see this? Oh, I have to scroll up a little bit more. Okay. And let's say that first big spike you see on the left, maybe you sign up here, and then for the next week or 2 or 3, maybe 2 months, you see this, right? It really drops. You say, this system sucks, and you are there, right? And then it just picks up. This is how it feels. This is how much money it makes, right? On how it feels within, let's say, a 30-day period.
So for those who don't know, a sharp of 1 is tradable. A sharp of 2 is brilliant. Yeah. Anything above that is pretty fragile.
Yeah.
So for quant traders that I know, generally sharp 2.0 is the holy grail. Sustainable is the holy grail.
Yeah, but very few people actually look at the system. They test it for 5 years and they say, okay, my sharp ratio is 3. That's excellent. Well, what's the standard deviation within that sharp ratio? Because you're not trading 3 years worth. You're always trading like a week or 2 week or 1 month at a time before you make up whether or not you're going to stick with the system. Isn't that true? I mean, come on. How many of you guys have traded systems? You sign up, you're all excited. All right, I'm going to trade the system. And then, maybe invariably the system hits a drawdown right when you sign up. And what happens? You say, okay, the system sucks. I can't do this anymore. And then you quit. And of course, the system immediately recovers and busts higher. You sign back up again, and it hits the next drawdown. This actually happens a lot with fund managers. I don't know who it was, but somebody actually wrote about that, a famous fund manager. I don't know if it was Bill Eckert, but it basically lamented the fact that a lot of his subs were, a lot of his own clients were constantly leaving during the drawdowns, and then when the system started kicking, which is of course lethal when you have a trend trading system. So this is how the system feels.
Coder actually told me that. He said his investors would drop out.
Who was Ken or who?
Ed Secoda.
Ed Secoda. Yeah, I love this guy. Yeah. Ed Secoda's awesome.
He used to say that investors in his fund say they want a marriage, but really they want a one-night stand.
I love that. That's a cool analogy.
Say we're going to be with you for 20 years, and the first little drawdown, they're out.
Yeah, guys, Vixen is a commitment. You so man up, right?
Sack up.
Exactly.
All right, so there is so you're going to get drawdowns like all systems. How?
No. You get drawdowns. I just want to. This just shows how the system feels like in terms of performance. Sometimes it's got SQL of sharp ratio here of like 6, but only momentarily, right? So it's just how the system feels, and that's the reality you're going to be facing with any system out there, even with the best system, and it's worse with the worst systems, right? This is combined average returns, blah, 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 doesn't matter. So here we're getting to the stuff that you kind of alluded to, combined trade score. So when we built the system, my quant buddy actually came up with this great idea to, he came up with this idea of scoring trades based on the behavior of the alpha factors that we measure, right? Let's say the VIX is one of them, and VIX is in a certain range, or VIX does certain things. And when you combine those, you basically establish relationships. And so he came up with a few rules that kind of made sense to him. And running the numbers over and over again. I think he did this for like over a month. It was a hell of a lot of work, and so he started to establish like a huge spreadsheet, Excel in this case, and it showed really how the system was differing in performance based on certain combinations of alpha factors that were behaving in a certain way, and so he came up with this concept of trade scoring, meaning that he wanted, when the system had a high probability of succeeding, he wanted to increase the trade score, and so would increase more, allocate more equity, right? So maybe as opposed to trading 0.8% per position size, you maybe trade 1% or 1.2. So we kind of scaled it up. We had trade scoring from like 1 to 3, 1 to 6, and 1 to 3 was like the crappy stuff, and after 3 it gets really good. So what you just saw was everything above 3. and that was the base statistic was, came out to expectancy of 0.32. And when we start to filter by, by 4, then you still got 1,300 trades. Well, here, I don't know, I highlight this for you. Bringing trade is still 50%, but max drawdown actually, again, that's all three together, 20%, and expectancy is now 0.38. So here, what we're doing, we're cranking it up to equals to 5 or higher, and now the expectancy actually jumped to 0.545, and this is
so how many trades did we skip out on to get that?
It does start skipping a little bit. That's why we have it set to 4 right now. You go from 1,300 trades now to 838 trades over 4 years, which again, all three symbols, right? Which of course is, I think that's absolutely tradable, right?
and there's nothing wrong with those trades that you're taking out. They're above point expectancy trades. They're great. They're trades that normal people would take, right?
Absolutely. I mean, anyone would love a consistent edge of 0.32, right? Look, it depends on what kind of trader you are. Are you really sensitive to drawdowns? Because the one thing that happened here, right? Max drawdown here is now 21. Again, three symbols. So you always have to divide that, by 3, right?
So 7, right? So you see a max drawdown of 7R.
Yeah. So we see that a bit. Yeah.
So let's get to practicality. So in the real world, you're going to join the signal service. You're going to pick one thing to trade, not 3. You can't trade 3 together.
Yeah.
And you're going to.
You can. You can. It's up to you. It depends on your capabilities, but yeah.
You would trade at 1% R values.
Okay, we're getting to that. So I personally, on my end, I trade between 0.5 and 1.2. Right.
Okay.
When the trade score is above 5, I trade 1.2. Above 5, so 6 and plus, I trade 1.2. If it's just 3 and 4, I trade 0.5% per symbol. So that's how I have it scaled, and the numbers will look very good in terms of you can really. This doesn't account for that, by the way. The stats do not account for doing that, right? You would take the same position size every day. So this really allows you to kind of decide which type of system you want to trade. I don't have it in the signal yet, but next week I'm adding the actual trade score to the alert, and then knowing that, you are able to decide whether or not you want to take this trade, right? Trade score will be 3, 4, 5, 6, right? And so you can decide which type of system you trade. If you arch conservative, you hate drawdowns, and you are willing to make a little bit less money at the same time, that's fine. Just then trade everything above 4 or 5 or whatever you choose. So I think it's a really effective way, and I've never seen this in a signal service either, that to really give you the ability to choose how much drawdown you're willing to tolerate. And this also allows you, if nothing else, you can do what we do, right? You can allot more money to the lower probability trades and more money to the higher probability trades. Make sense?
Mm-hmm.
Yeah. Okay. So here I'm kind of stretching it out. I'm pulling out the VXX by itself. Same thing. I'll give you an idea. Let's say you would just trade the VXX. That's a raw symbol. The raw signal, 0.34 R, and drawdown here was 13 on that one. Again, unfiltered. That one symbol over 4 years. That's not bad, but it might not be, let's say, if you're a fund manager, you probably don't want to trade the raw signal, because after 7-8% drawdown, you probably lose a lot of clients. So we get to that. That's why we start filtering here. That's +4. And here the max drawdown has dropped to 10.45, and the expectancy is at 0.39. And again, when the win to loss ratio also remains around the center. It doesn't move much. It's really interesting, no matter what we did. So I think it's just that you cannot predict. You just have to exploit. I think it's really a good learning experience, maybe also for you guys if you're building your own systems. We all want to have systems that have a 70% win rate, and sometimes maybe one day maybe you'll find it. I never got over 65% no matter what system I traded.
It's emotionally easier to trade low win, to trade systems that are around 50% anyway. Because if you're not expecting everything to be a winner, then it never takes you by surprise, right?
Yeah, there's many aspects to that. Maybe we should do another video on this. The one is that, you know, it can also be very seductive to trade a system that has a 70-80% supposed win rate, and you start accepting that as your new normal. But which really rarely happens. When drawdowns happens, you really kind of have a tendency to completely, be taken by surprise, and it might actually lead you to doubt your system. The other thing that, and again, very few people talk about this, is that you. Let me switch over here quick. When you have a system that you do compounding, right? And there's some paper I've actually written about this. When you compound over time, if you have a system, and I ran the math, I wrote actually a post about this. If you have a system with a very high win rate, you actually have a harder time compounding it. Because a lot of times your position sizing, right? It actually increases to a certain point, so you actually really keep up with statistical compounding. It's actually better to trade 50-50 systems.
When you try and compound a high win rate system, what happens is that your initial part of the drawdown happens when you're trading these really big position sizes because you compound it up so fast. Yeah. So it exacerbates your drawdowns.
Yes, exactly. And that's also why you have a hard time keeping up with theoretical compounding. And as that changes, right, over time, you're losing out on a lot. It's actually better to trade systems. And that's really took me completely by surprise. I have to dig up that post, and maybe I can...
We got to keep pushing through this, man. We're over an hour already. No one's going to listen to us for more than an hour.
Okay. Well, we're almost done, actually. So thanks, guys, for sticking with me. Here's the VXX. Yeah, let's push through. We give ourselves 2 minutes to push through this, so bear with us. 53%, 45R, that's sweet if you just trade the VXX. UVXY, that's 544 trades. That's a raw system again, 48%. Expectancy is kind of low here, but it kind of cranks up hugely as you go into trade scoring above 4, right? 0.38 right away, and then it jumps to 0.4.
So from my point of view, anything above 0.2 on a fully automated system is pretty damn good.
Yeah, no, I agree. Let's not lose sight of that, right? Here's the SVXY, which probably a lot of you guys will trade because you can go long on it, and it starts with 0.32, like the combined system. It's right in the center. I like that. Then it from straight trade scoring at 4, it jumps to 0.36, and here it actually jumps to 0.49. So we almost have a 50, a half. I have a point. I have our win rate expectancy, which is brilliant, right? And drawdowns are still, tolerable. Here it's 12.
11 hour and 4.9. Totally fine.
It's fine. You're doing some return correlations, which which is really kind of not important. I think we should probably cut it off here because this is really the meat of it, right? This really shows us how the system behaves, and how the statistics kind of slightly shift, and how you're able to choose between the characteristic of the system you want to trade.
Bottom line, you're a subscriber on my list. You're thinking about trading Vixen via your signal service. What's your best guess? Which one would you trade? What would you do? Would you do it? SVXY would be the one I'd be leaning towards.
Again, it depends on your broker, right? If you're allowed to borrow the VXY or VXX, I definitely go for that. I mean, they're very liquid. If you can, then just go with the SVXY and go along. That's what I would do, or trade options if you want to.
Retirement account, then you can only go long. So SVXY is your thing.
In that case, yes. If you have an IRA or something where you can only go long. All
right. So we're going to have to wrap this up because we've gone for over an hour. But the bottom line is, I hope you've all seen that this extraordinarily well-researched system. It's truly a professional grade system. You've got institutional clients trading this right now, right?
Absolutely. That's how we developed it, right? I mean, it has to hold up in an institutional setting. So it's so absolutely trade in an institutional setting. Actually, these types of systems, IV systems, are traded hugely by institutional traders. It's just not, it doesn't hit the news right much.
Okay, so if you're looking for an opportunity to trade like a proper institutional quant system, just like the big banks trade, Michael, you're going to do us all a deal and let people who are part of our community have a free trial of your thing, right?
Yeah, 2 weeks. Yeah, you get 2 weeks you get a free signal for 2 weeks, and you can observe it, you can watch it, and get a feel for it. I think that gives you the idea of how it works and how it flows and how you can trade it.
All right, so I think we should do one more webinar, and in that we'll get people to sign up live for the trial, and we'll get you to demonstrate it and walk us through in a very simple way exactly how it works from start to finish, so we can see, how feasible is it for the average Joe to do. And because I know what a lot of people think when they see a complicated system like this is, oh yeah, sure, you can do it because you're this like super nerd maths geek, but I could never do that. But what I'm here to tell you is that Michael's made it so you can actually do this, and I can actually do this, and I don't have them. I don't have the.
I think it's going to be a short webinar then, because I show you the alert you get, and that's on how it hits, and that's, you just put in the order, and that's basically it. There's not much else to do. There's nothing to think about or measure. I actually wrote this really cool. I'm showing you next time position size calculator that makes it easier for you guys. So we cover that as well next time. All right.
All right, man. Thank you very much for your time. And,
thank you.
I'm really looking forward to it.
You, me too. Excellent. Thanks for having me. Cheers.
Take care, man. Bye-bye.
Bye.